From quietly powering India's pharmaceutical exports to scripting a bold new chapter, Supriya Lifesciences has come a long way. Established in 1987 as a niche manufacturer of active pharmaceutical ingredients or API, this small cap player has since grown into a global leader in select molecules. But now it's eyeing a second act, diversifying beyond APIs into high potential areas like contract development and manufacturing, CDMO, contrast media, and nutraceuticals. However, the road ahead will not be easy. It has to navigate changing market conditions, expansion pressures, and the challenges of transitioning from a legacy business to a future-ready pharmaceutical player. Welcome to Bottomline by Groww. In today's episode, we explore the journey of a small cap company, Supriya Lifesciences Ltd, and what lies ahead for the company. Supriya Lifesciences carved out its niche by developing and commercializing both APIs and FDFs, which is finished dosage forms. What do we mean? APIs are the key ingredient in medicines, like paracetamol, that provide the therapeutic effect. Once this core ingredient is ready, it's combined with other elements to create the FDF, the final tablet capsule or injectable that reaches patients. Supriya Lifesciences quickly distinguished itself, becoming a global leader and the foremost exporters in APIs like antihistamines, anti-allergics, vitamins, anti-asthmatics, and anesthetics. With over 40 APIs in its portfolio, the company has expanded its reach across more than 120 countries, serving over 1,500 customers. The strong export focus is evident as almost 85% of its revenue comes from the overseas market, with Europe being the largest at 36%, followed by Asia 30% and Latin America 26%. A key growth pillar has been its backward integration model. This means the company manufactures critical raw materials and intermediates internally rather than relying on third-party suppliers. Out of its 40 plus APIs, 15 are fully backward integrated, accounting for nearly 72% of the company's revenue in FY25. This strategic approach directly enhances control over vital inputs, optimizes cost structures, and provides insulation from global raw material volatility. As such, when Supriya Lifesciences was listed in 2021, its stock rallied significantly since its debut, reaching an all-time high in April 2025, more than 100% rally. So everything is going good for the company. It reported strong double-digit margins, net profit crossed 100 crore rupees, and the balance sheet remained debt-light. FY25 too had been a good year. The company's revenue grew by 22% in FY25 from last year, with a compounded growth rate of 15% over the last 4 years, and it recorded a 16% YOY growth in revenues in the March quarter. It also saw a 51% EBITDA growth in FY25 and a 58% increase in net profit in the last year, achieving EBITDA and profit margins of 37% and 27% respectively. However, there are some concerns despite the seemingly stable fundamentals. 1. The company's portfolio concentration. The company makes over 40 APIs, but despite reducing reliance on its top 10 molecules, revenue remains concentrated in mature therapies like anesthetics and antihistamines. Its top 3 molecules, ketamine hydrochloride, chlorpheniramine maleate, and salbutamol sulfate, continue to account for more than 55% of its revenues. 2. Higher client concentration. The company exports to over 85 countries, mostly concentrated in Europe and Asia. In FY25, the top 10 customers contributed 58% of revenue, indicating high client concentration. Any order loss or regulatory change in key markets could significantly impact performance. For instance, during the COVID-19 pandemic, China, one of the company's key export markets, faced lockdowns and economic slowdown, impacting performance. So in FY23, revenue fell 13% YOY and operating margins dropped to 28% from 40% in FY23. With nearly 85% of the company's revenue coming from exports, this exposes it to significant foreign currency fluctuation risks. This apart, the company's profitability is sensitive to raw material price fluctuations and realizations of finished products. For instance, in FY24, the Russia-Ukraine war disrupted procurement, causing delays and higher input costs. Lastly, Supriya Lifesciences has high working capital needs, mainly due to the elevated inventory levels, 150 to 160 days and 205 days in FY25. This is to support global operations and cushion against supply chain disruptions. So what is the company doing to address these concerns? Well, it's diversifying. Big time. First, the company is making moves into new verticals: CDMO, contrast media, and nutraceuticals. A CDMO is a specialized partner that provides drug development and manufacturing services on a contract basis. The company is making strong headway in CDMO, expecting it to contribute 30 to 35% of future revenues. To support CDMO expansion, Supriya has invested in its Undervalued facility, adding new lines like liquid anesthetics, inhalants, and injectables, tapping into India's fast-growing $25 billion CDMO opportunity by 2032. Second, Supriya Life Sciences is also expanding its product portfolio with strategic new launches. In Q4 FY25, it launched a new API product in the anesthetics category, targeting a global market size of $300 million with expected meaningful revenue contributions from FY26. For FY26, Supriya plans to launch 3 more new products in the ADHD, contrast media, and cardiovascular drug categories, addressing a total global API market of nearly $1 billion. Notably, it's targeting a 20% market share in the large contrast media product, as it is a significant product in regulated markets. This expansion also geared towards eliminating reliance on Chinese manufacturers by targeting high-potential, undersupplied molecules currently dominated by China. This move aims to gain pricing power and unlock superior margins in the coming years. Third, it's also reducing its customer concentration going forward. And lastly, in terms of working capital requirements, as per the management, it is able to manage well with no additional borrowings or breach in working capital limits. The management expects the working capital days to remain in the range of 150 to 160 days in the coming quarters. Further, the high working capital intensity is partly mitigated by the company's strong liquidity position. The company has a healthy cash reserve of 761 crore rupees and remarkably minimal borrowings at just 5 crore rupees, which have significantly reduced over the years. This strong balance sheet provides the company with the time needed for its new ventures to scale up. While the company's capital expenditure for FY25 was 162 crore rupees, primarily for expanding manufacturing capacity, including the Undervalued facility, the anticipated capex for FY26 is reduced to 75 to 80 crore rupees, focusing on maintenance and smaller projects. So how is the valuation looking for the company? Currently, it's trading at a PE ratio of about 30 times. While it is higher than its median PE of 24 times, the company trades well below its peers. Its EV to EBITDA metric is on the higher side. Its current market valuation could suggest that the market is already pricing in its transition from a pure-play API exporter to a more diversified pharmaceutical entity. Supriya Life Sciences was never built for the hype. It quietly mastered niche molecules and scaled globally. Its first act as a niche API player made it a star, but that story has matured. Now the market is eager to see what's next. The bets on CDMO, nutraceuticals, and contrast media are high-margin ventures, but they demand scale, speed, and precise execution. As India's pharma evolution continues, Supriya Life Sciences is certainly a stock to watch. So, what do you think? Is Supriya Life Sciences a quiet compounder in transition? Let us know your thoughts in the comments section. And for more such insights, do remember to hit the subscribe button to Bottomline by Groww.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and or other instruments traded on the stock exchanges.